Thank you, Adrian. So thank you, everyone, for joining me here. Hopefully, everyone can leave our 2-hour session knowing more, maybe more than you ever wanted to know about tax. And just as by way of introduction, I'm a CPA. I work exclusively with small businesses. The folks I work with, I should say my name's Nels Larson. You probably already got that when you signed up. I work exclusively with small businesses, or what I call solopreneurs, on up to my bigger clients maybe have about 25 employees. And so small businesses are really what I'm passionate about. And this isn't a commercial for me. This is just me sharing information. So, and I can see Betsy, of course. I think nobody spends any time in Grand Marais without knowing who Betsy Bowen is. But I just want to get a quick idea of what everyone's business is, because then I can kind of tailor my comments and my presentation to hopefully for a few more takeaways. So Betsy, obviously you know, I think a prolific artist. I know you're in the old church there, and do you have any business going on that you're trying to get some tax information about that would be applicable other than your art business?
Well, I have the art gallery, which is more of a retail kind of a thing. And then I also have, well, a different aspect of it a little bit is contract work where, for instance, book illustration for which I would receive royalties.
Oh, sure. Okay.
And there's also a strong component of what we do that's wholesale. So we're shipping out, for instance, greeting cards and calendars and original artwork to other outlets that are, you know, either on a retail or a consignment basis. So there's a couple of components. It's really all about drawing pictures, which I have loved to do since I was a little kid.
Sure. Okay, cool. All right. Thank you, Betsy. And we'll come to Terry in a minute, but Jake, I know you're unmuted. So Jake, is there any particular business or industry that you're involved with that you're looking to get information for?
Yeah,
so I can help tailor my comments.
I retired from the school district, local school district here a couple of years ago, and I was the head of the technology department. And so what I've done is I've got a Jake's Computer and Technology Services business. I try and focus in on the home users. And so I'm interested in the class. Sounds right up my alley.
Okay. All right. Thank you, Jake.
Yep.
And then Terry.
Hi.
Hi there.
I'm like Betsy. I'm Grand Marais. I do the markets, so I sell my art. And this is my first year I've ever put my taxes in as a business because it was a pretty good year. So I figured I might as well pay my share. And for me, it's all about the deductions. You know, it's so much fun buying something if I know I'll be able to take it off my business.
Sure. I get it. I understand. Okay. All right. Thank you, Terry. So I'm going to, and I apologize, I'm going to make sure that okay, so we don't need to look at me anymore. So we'll spend maybe just about 5-10 minutes top. So it's 6:05. And as I was putting my slides together, at least the rough draft of my slides, I realized I probably had 10 hours of material. So maybe I was overly ambitious, but I'm going to just take about 10 minutes and go through the different kinds of entities for tax purposes that there are. And if I'm boring anyone, I'll apologize in advance. but I think it's important to kind of know where you fit in, or if you've got a new business, you know, what your options are if you wanted to maybe even consider being a different entity for tax purposes. So for small businesses, you know, a lot of businesses start off in the upper left corner here, what we call a sole proprietor. And a sole proprietor is you don't even have to file any paperwork. If you're just out there selling your wares or providing a service and you don't do anything to create a new entity or to create a separate legal entity, by default, you're a sole proprietor. And then for tax purposes, sole proprietors typically are filing their business activity on Schedule C of their personal return. Okay. Sole proprietors, typically it's just one owner, as the name implies. Sometimes you can have a business that's taxed as a sole proprietor if it's co-owned by a husband or, you know, by spouses. And so that's why I say one or two owners there. And then typically you're paying, of course, income tax, but then any profit from that business is going to be subject also to what we call self-employment tax, or sometimes you'll see it abbreviated SE tax. What self-employment tax is, it equals 15.3%. And, you know, probably everyone at some point had a job where you got a W-2 from your employer. And if you ever look close at your W-2, you'll see that there were wages, there was money withheld from you that your employer withheld and paid to the IRS specifically for the Social Security program and for the Medicare program. And those amounts that would have been withheld from you as an employee would equal 7.65%. And what happens when you are a sole proprietor, you are in effect standing in the shoes of both the employee and the employer. And so you're paying not only the employee share, 7.65% of the Social Security and Medicare tax, but you're also paying the employer portion, which is another 7.65%, which is how we come to that 15.3% I mentioned a minute ago. So that's generally referred to as self-employment tax. So that's if you're doing business as a sole proprietor. And I should mention, I know a lot of people, when I talk to someone, maybe they've been in business for a long time or they're just starting a business, and they say, oh, I created an LLC for tax purposes. And when you create an LLC, you're actually not doing anything for tax purposes. Creating an LLC, all that does is it gives you, LLC is just an acronym for limited liability company, right? And so really when you create an LLC, all you're doing is you're putting a layer of legal protection between you personally and your business activity. And I should throw a caveat out. I'm not an attorney, nor do I play one on TV. Usually I get laughs when I say it, but anyway, that's a tough room tonight. Anyway, so my caveat is that I as a CPA, I can talk about taxes all the time, but sometimes tax and legal stuff overlaps. And I need to just make it clear I'm not an attorney and I'm not giving legal advice. And we have that on the recording now too, right, Adria? So I'm covered. But so when you create an LLC, just the act of creating an LLC, if you started off as a sole proprietor, all you've done is you've created, for tax purposes, you haven't done anything beneficial. You've just created, as long as you do everything correctly from a legal perspective, you just have given yourself a legal liability shield between your personal assets and your business activity. The IRS actually doesn't say specifically when you're an LLC how you are taxed. If you're a sole proprietor and you create an LLC, even if you go get a tax ID number, the default is you're still going to be taxed as a sole proprietor. And I'll talk more about LLCs in a few minutes, but I'm going to talk about kind of the next step up in terms of business entity or business structure types for tax purposes is a partnership. So we already talked about sole proprietors. Since we just have 3 or 4, Adria, including you, because I know you're into pot, you do ceramics, right? Pottery. Do you have a pottery business, Adria?
Yeah, so it looks like we have, how many people do we have total? 1, 2, 3, 4. There's 5 people other than myself attending. So yeah, I have so I do ceramics and jewelry. So I'm
Okay.
a working artist in addition to
Yep.
working at Cook County Higher Ed. And
Okay.
previous to moving here, I was also a therapist.
Oh,
So I did have a sole proprietor set up because I was a contract employee at a group practice. Since moving here, I haven't set things up quite the same way, and I am a little confused on it. So I'm glad that I'm here tonight because it'll be helpful for me
sure.
to hear some of this information. Yeah.
Okay.
Because I end up selling my work on my own website, and then I sell at shops too on consignment.
Oh, sure. Okay.
So, then that's a little different. And then I
Mhm.
do also have some wholesale accounts for other, like I make incense burners, and so I sell incense to go along with them.
Okay.
Yeah, so I'm interested to hear what you have to tell us today.
Got it. So, and I just wanted to make sure because I think Kelsey and I had emailed and she had mentioned that you had other business activities. So, so going from partnership or from sole proprietor up, the next step up is partnership. And when you have a partnership, the definition requires there to be at least 2 people or 2 entities to have a partnership. So if I don't have anyone that I'm in business with, I cannot be a partnership because I'm just flying solo, probably like all of you are. If you have a partnership, then that's to the point where we're actually filing a separate standalone business income tax return. So we're not filing, so the business activity isn't going on your personal return, it's going on a separate standalone business return. In this case, the IRS form is 1065. You have to have more than one owner. And what happens is when we do the partnership return, when we prepare the return, we show your sales and we show your expenses and we arrive at taxable income. But the partnership itself doesn't pay income tax. Instead, it distributes a form, which I have on the slide here. The form is called a K1. I don't have the form, I just have the form name. The form is called a K1. And so when the partnership tax return gets prepared, let's say there are 3 partners, and let's say those 3 partners are all have equal shares. So it's a third, a third, a third for each of the 3 partners. Each partner is going to get a K1, and it's probably going to show that they each get 1/3 of whatever the profit or loss from the business was. And you can have partnerships, they can get very complex. So I'm not going to talk too much about them. But you will see partnerships if anyone owns real estate, whether it's commercial or residential rental, and you have more than one owner. Often the real estate for income tax purposes is treated as a partnership. It might legally have LLC at the end of the name, but for tax purposes, it gets taxed as a partnership. And then regardless of what the underlying business activity is, each of the partners gets that K1 form, and it shows what their share of the income or loss is from the business activity. And then they add that, or they pick that number up on their personal income tax return. So even though the partnership return is filing a separate income tax return, it's still not actually paying income tax at the partnership level. That's still gets picked up at the personal level. And then depending on what the partnership activity is, let's say I have a business partner. So me and another CPA are in business, and we are 50-50 owners. Then any profit that we have at the end of the year, let's say we have a profit of $100,000 and we're going to split that 50-50. So I'm going to get a K1 that shows I have $50,000 of income. And because I was actively working in the business as a partner, then my $50,000 of income is going to be subject not only to income tax, but remember I mentioned the self-employment tax earlier, which is the Social Security and Medicare. So partnership income that flows through to the partners is going to be subject to self-employment tax. So in my example, my $50,000 coming to me is going to be subject not only to income tax, but it's going to be subject to that 15.3% self-employment tax for for Social Security and Medicare. So partnerships have tax advantages and I would say disadvantages. And then moving up the food chain, so to speak. Now, actually, I've got these out of order, but I'm going to talk about on the right-hand side where it says S Corp. So an S Corp is a business entity that for a lot of respects, it gets treated like a partnership that I just discussed. And you can actually have one owner that owns an S Corp. Remember I said a partnership, you had to have at least two. So that's one difference right there. The S Corp does file like a partnership. It does file a separate standalone business income tax return. And it has that same format where it doesn't pay income tax at the business level. However many shareholders there are in an S corporation, they will receive that K-1 form, and it will show what each shareholder's share of the profit or loss is based on their ownership percentage. And unlike a partnership in an S Corp, sometimes it makes sense if you are an S Corp shareholder and you work actively in the business, you need to actually take payroll. So you would get a W-2 in January of the following year. And then any profit left over after your W-2 would be reported on your K-1. Now, the income that gets reported to you on your W-2 as an employee, that will be subject to the self-employment tax. However, any income still in the business that gets reported to you on your K-1 does not get subject to that 15.3 self-employment tax. So this is a big tax savings deal when people, even if you're a sole, in fact, I'm just one person in my practice. I actually am taxed as an S Corp. So I have my business pays me a salary, and then I get a W-2 for that. But then whatever remaining profit is in the business that gets reported on my K-1, yes, it's subject to income tax, but no, it is not subject to that 15.3% self-employment or payroll tax. So that's one big tax advantage of being an S Corp, particularly over a partnership. And in some cases, depending on how big your profit number is in your business, it might make sense to be an S Corp over being a sole proprietor. In order to be an S Corp, you can be a sole proprietor and have LLC at the end of your business name, and you can elect, you file a form one time with the IRS. Basically what you're doing is you're putting your hand up in the air and you're saying, oh, by the way, IRS, I want my business to be taxed as an S corporation. And you file that form with the IRS, and right now they're a little slow in processing those forms because they're pretty backlogged, particularly due to COVID. But then you can be taxed as an S Corp. And again, depending on where your numbers fall, particularly for profitability, that might make sense to be taxed as an S Corp instead of a sole proprietorship or instead of a partnership. I just want to mention on the left-hand column here, I've got C Corporation. And this is, I'm going to talk about C Corps for about 30 seconds here. Very rare do I find a small business, say, with fewer than 50 employees, that is a C Corp. C corporations generally are big companies. Oftentimes they're publicly traded. So think 3M, IBM, McDonald's. I shouldn't have said McDonald's. I didn't eat dinner, so I'm getting to be hungry. But the C Corp isn't, it's much more expensive. And for reasons I'm really not going to dive into, it's not going to really make sense for any small business owners. So moving along, now I've mentioned LLCs. You know, what the heck is an LLC? You know, limited liability company. The reason an LLC was created had nothing to do with tax purposes. It just was to enable basically people who are doing business as sole proprietors to get some of that legal liability, or liability shield between their personal assets and their business. The IRS at first, when LLCs first became a thing about 30 years ago, the IRS didn't even know how in the heck to treat them for tax purposes. And so the IRS said, okay, so basically you can decide how you want your LLC to be taxed. By default, if you just are one owner, you're taxed as a sole proprietor. You can elect to be taxed as a partnership if there are, two or more of you, or even if it's just one of you, you can elect, as I mentioned a minute ago, you can elect to be taxed as an S corp. This is again where I would say, it probably wouldn't be a bad idea to talk with a small business attorney who understands some of the complexities involved from a legal standpoint. So, as we mentioned in the write-up, the name of the class is tax savings ideas for small business. So we're going to dive into, I think I've got about 6 areas here where I see people either don't do things right, or maybe they aren't aware of certain things. Vehicle deductions. And I should mention that before I dive into the nuts and bolts, the mechanics for how we deduct vehicles can be different depending on what kind of tax structure you've got. An S corp might have to handle something different than a sole proprietor, might be different than a partnership. But the same concepts are going to hold for all of these. So vehicle deductions, I'm just going to take a wild guess that everybody here does some driving for business purposes. Now, typically those, business driving, and I know for folks in Grand Marais, it's not uncommon to drive to Duluth, to pick up supplies for various things. I know one business owner, I think she literally drives to Duluth every 2 weeks for supplies. And it's probably the same for a lot of folks in town. So all those, if you're driving from Grand Marais to Duluth, and even if you stop to visit a friend on the way or visit a friend in Duluth, but if you go to Office Depot, or I don't think Office Max exists anymore. Staples, I don't even know if Staples is around, I guess. I don't get out of the house much, so but any driving that you're doing for for business purposes, whether it's picking up supplies or for the artists in the group, if you've got stuff that's for sale on consignment and you're replenishing consignment supplies at different gift shops in the area on the shore. Jake, if you're driving to Duluth to pick up hardware that you're going to install or sell for a client, or that's even going to be for business use, but internally for you, all those miles are going to be business miles. So when we do, there are basically 2 ways we can deduct business miles. There's the standard deduction, which I think most people have heard of, and that's a number that changes a few cents every year, kind of up and down. Oftentimes it fluctuates with gas prices. And that's where the IRS says it costs on average 58.5 cents to run, operate a car. And then the other method is what we call the actual expense method. Now, both of these methods are going to require you to track all of the driving that you do in your vehicle. So if you've got, whatever your vehicle is, and some people I know get a little loosey-goosey with this. And I will tell you that I have clients that tell me what their numbers are, and I can pretty much, I'm 90% certain that some of those clients aren't actually tracking their miles. I can still deduct them on the tax return. However, in the event that, the statistically unlikely event that the IRS decides to audit that client, the IRS knows that people tend to be a little fast and loose in this area. And one of the first things that they ask small business owners for is, can I see your mileage log, or can I see your mileage reports for your vehicle? So if you want to be bulletproof in the event of an audit, you would have to, either one of these methods is going to require you to track basically all your driving. So let's say you drive, in fact, I think, let me just advance one more slide here. Okay, so you can see, I mentioned here that if you track all your driving, and let's just for easy math say that you drive a total of 10,000 miles in a year. In order to use the actual mileage or the actual expense method, you have to have 50% or more of your driving has to be done for business purposes. So in that mathematical example, if you drove a total of 10,000 miles, you'd have to drive at least 5,000 miles for business. If you didn't, if you drove 4,999 miles or fewer in the year, you can only use that standard mileage rate method. So, and again, that's going to change a little bit from year to year based mostly on the price of gasoline. And the IRS publishes those numbers. Usually they publish them in the fall of, like, I think we got our 2022 numbers in 2020, like November 2021. So tracking mileage is going to be important. And then in the first year, if you wind up having 50% or more of your, so I'm sorry, in the first year that you have a vehicle that you use for business, let's say, Betsy, I'm going to just take you, for example. You've been in business for years. I think I know a little about your story. I've been in your gallery in the church basement there. I know my daughters have some prints. So let's say that you've been in business for 20 years. Maybe it's even been longer than that. But so let's say this year in 2022, you get a new vehicle and you track your mileage, on that vehicle for 2022. And when all is said and done, it turns out that you drove that vehicle 10,000 miles total in 2022, and you drove that vehicle 5,001 miles in 2022. So if we decide to, we can use the actual expense method, which is great. And if in the first year, if you qualify and you decide to, in fact, use the actual expense method for vehicle deductions, then every year going forward, so not only the 2022 tax year, but 2023, 2024, you have the ability to flip-flop between these two methods. And so you can literally do the math each year and see which method gives you the bigger vehicle deduction. So that's awesome. Now, if in 2022, Betsy, you drive a total of 10,000 miles in that new vehicle, and when I say new, I mean new to you. It doesn't have to be brand new vehicle, of course. And let's say you actually drove 4,999 miles for business. So we can't meet that 50% or more threshold. So we can only do the standard mileage rate. So in that first year, if you use the standard mileage rate, as long as you own that vehicle, you can only, for vehicle deduction purposes going forward in future tax years, we can only use the standard mileage rate. We don't have the ability to flip-flop between the two methods and see which one will give us the better answer, the higher deduction. And I just realized I didn't actually talk about what in the heck is this actual expense deduction. So what the actual expense deduction is, we take all the expenses that you incur for owning and maintaining your vehicle. So if you lease the vehicle, we can take your lease payments. If you own the vehicle, but you're, it's like having a mortgage on a car, only it's usually 5 to 7 years. We can take the interest on your car payment, and we can take your gas expenses, your maintenance expenses, your insurance, obviously car washes, We can also take depreciation, and that can be a pretty sizable number, which I'll touch on in just a couple minutes here. So we take all your actual expenses and then whatever our percentage is. So in Betsy's case, if she's at, 50.01%, if she, winds up driving 5,001 miles out of the 10,000 total, we take all her actual expenses for owning and maintaining her vehicle in 2022, and we multiply them by 50.01%. And then that will give us our actual expense number. And that number, is probably going to be higher than just using the standard mileage number that the IRS puts out every year.
We have a quick question now.
Oh yeah, for sure.
So are there any tools for tracking mileage or apps for people's phones that you would suggest that people use?
That's a great question. There are there's an app for everything nowadays, right?
Sure are.
And I suspect I wouldn't be shocked if there are like 100 apps for this. There's one I know of that I see often called Mile IQ. So it's just like literally the word mile, MILEIQ. And I've been married for almost 30 years, and so I'm too old to really know what Tinder is, but I'm told it acts like Tinder, where apparently Tinder is like a dating app, and you swipe left if it's somebody that you're interested in, or you swipe right if it's someone you're not interested in. So with Mile IQ, you obviously you have to bring it with you, so your phone is literally tracking you wherever you go, just in case you don't already feel like we live in a Big Brother society, but that's an aside. And every drive that you make, your phone will record it, and then at the end of the day or the end of the week or the end of the month, although I wouldn't suggest waiting that long, you literally go through and it will show you on your phone each drive, and then you swipe one direction if it's a personal trip, and you swipe the other direction if it's a business trip. And then Mile IQ will literally track all your driving for you, which is pretty darn slick. And there are Mile IQ, I think it's there. I want to say there's a free version that might be good for 20 or 25 driving trips worth of tracking. I think it's a month. And then, there's a paid version on, I know that might track 100 drives a month. And then I think there are, more expensive versions if you're like doing Uber or Lyft or something like that, where you're, literally could have hundreds of driving trips in a month. I feel like that first version, not the free one, but the intermediate one is maybe $5 or $7 a month. I think it's not outrageous. And I'm sure there are many other, I'm sure if you went to the App Store or the Google Store and just did mileage tracking apps, you'd probably come up with like 50 right away. So does that answer the question, whoever had the question? I'll just go with a yes. I don't know. I didn't see any heads.
They said yes. So
okay, got it. Okay, good.
Thank you very much, Nels.
Okay, so I guess here in my slide, which I didn't advance to, I just used this example of 10,000 total miles, 6,500 were business, so I gave us 65%. So in that case, we could use the actual expense method. Down below, I said, okay, so what if we drove 13,500 miles total, but we drove the same 6,500, then our business use is 48%. So you can see in this case, we'd have to use a standard deduction. And for our number for 2021 was 56 cents a mile. So if you're doing your own tax return or you're pulling numbers together for your tax professional or CPA, just know that 56 cents a mile was the 2021 number. The 2022 number is 58.5 cents a mile. So it went up 2.5 cents. So in that case, it's much easier doing the calculation, right? You just have to know how many business miles you drove and then multiply them by, whatever the IRS number is for that year. Now, one thing I want to, talking about vehicle miles, I want to make sure that people understand that it's, getting supplies, but also, and I realize Grand Marais is not that big, but, and Betsy, I don't know where you live, but let's say you live up near Hoveland and you're, what is it, probably 15, is it 15, 17 miles up to Hoveland, something like that. So let's say you had to drive in every day to your gallery on the hill there. And so just driving literally from home to work and back, let's say it's 17 miles one way, well, it's 34 miles round trip. If you claim, and I'll come to this a little bit later, but if you claim a home office deduction, then we've just turned those miles, instead of commuting miles, which the IRS would say don't count towards business miles. If you're making a home office deduction on your return, now those miles are business miles because you're driving from your home office to your, we'll say, retail office. Okay. We know, I mean, like Sievertson's, that's a great example. I mean, they've got 2 locations, right? They've got Duluth, and then they've got right in town in Grand Marais. So if, I don't know the family, I just know the names, but if, someone with the last name of Sievertson or some other employee is driving back and forth between those locations, those are for sure business miles. And so as a small business owner, I always encourage all my small business clients, even if they've got a separate office or a separate location, make sure you're doing a home office deduction. Then you can convert those miles to business expense miles. Adria, you have a question?
Yeah, I have a question with my own personal example. So I run my website at home in my own home office, and I ship and pack orders from home, and do all the, all those businessy kinds of things from home. But then I'm making my pottery and firing my pottery at a studio in town.
Sure.
So does that trip to the studio then count as business mileage or no?
I would say yes.
Confusing. Yes.
Yeah,
okay.
you've got a home office, which is like I would call that like your administrative and shipping office, right? You're doing your own internal, accounting or, bookkeeping, money stuff. You're managing the business website from the home office. You're shipping, packing product from the home office, but you go to the, I don't know if it's the Art Colony, on the hill there, probably to fire up. I'm looking forward to seeing some of your stuff sometime. I better not bring my wife. My wife goes nuts over blue bowls. Anything Joan Farnham makes a blue bowl, my wife.
Yeah.
And every time we break one, I'm like, oh, there's another sale for Joan. Anyway, so does that answer your question for you?
Yeah, thank you very much. That's helpful.
Yeah, you bet. Does anyone else have questions about and I'll dive more into like the home office, the tax benefits besides, but in order to get that, make sure we can get those miles from your home office to, your day office, if you will. In order to make sure those miles are, going to count and going to be rock solid, we need to make sure we're claiming that home office deduction. So, okay. Just a couple other things, and here I'm just working through some more of this vehicle deduction math. I talk about gas, insurance, maintenance. If you have a loan, the interest on the loan would be deductible. I mentioned depreciation too. And depreciation could easily be its own. We could talk for 8 hours about depreciation. Let me rephrase that. I could talk for 8 hours about depreciation. You guys would fall asleep. But there are certain things regarding depreciation is the concept that when you have an asset for business, and let's say it's a vehicle that you paid $30,000 for. Most passenger vehicles and trucks, SUVs, the IRS says they have a useful life. Jake, I can see I'm riveting, right? The IRS says that those vehicles have, for tax purposes, they have a 5-year useful life. And so for tax purposes, if you qualify to use the actual expense method, depreciation can be a pretty big component of your actual expenses. And for some people can be a reason why some people will actually, if they have two vehicles, they'll actually manage their driving that they do of, say, their primary business vehicle. And then they'll make sure that, I'm going to Duluth, but it's not a business trip. It's strictly fun shopping, or I'm doing a road trip or whatever. And I'm going to make sure I take my strictly personal use vehicle. So that they can manage and minimize the personal miles they're putting on the vehicle that they would otherwise primarily be using for business. But the depreciation number can be pretty significant, particularly if you do wind up with a pickup truck or an SUV. If you've got a truck or an SUV that comes in at 6,000 pounds or more, it actually is eligible for what we call bonus depreciation. So instead of having to depreciate the vehicle over a 5-year period, we can actually depreciate most of the vehicle in the first year. And that is why most of us, maybe some of you even done this, but oftentimes you hear a lot of car ads geared towards, show your significant other you love them, go buy them a new $70,000 Lexus sedan, if you want to put a price tag on love. But a lot of small business owners will go, oh gosh, I need to go out and buy a vehicle, because there can be certain depreciation benefits around buying a vehicle. They buy that vehicle in December. They manage it very much so that they're literally just driving that vehicle for business purposes the month of December, not driving any personal or very minimal personal. And then they can get a much higher actual expenses for that new vehicle they placed in service in December. The depreciation on some of these vehicles, like let's say you go out and you buy a new, and again, it doesn't have to be brand new, just new to you, new to your business, pickup truck, $30,000. Let's say you buy it in December. And let's say you manage it so that you're driving in December and that truck that you paid 30 grand for is 100% business. If you would have done that this past December, when we go to file your 2021 tax returns, we could actually deduct all $30,000 of that cost of that new to you truck or SUV, as long as it met the 6,000 pound gross vehicle weight. And I have this term here, placed in service date. And so that's what we talk about. The IRS, it's a tax terminology, and hopefully you forget it as soon as we log off here. But it's good to know that when you're thinking of buying a new vehicle and that vehicle is going to be used for business, maybe it makes sense to try to defer that purchase to later in the year. So it will give you the opportunity to manage, to make sure that the percentage of miles you're going to be driving are going to be as much business or skewed highly to business as possible. There's nothing untoward about this. The IRS would have no compunction with it. It's just, I guess, really, it's tax planning, and a lot of us just aren't even aware of things like this that we could be doing. I mentioned depreciation. I think nobody here, if anyone owns a rental property, whether if it's a commercial building, it gets depreciated over 39 years. If it's a residential rental building, it gets depreciated over 27.5 years. Just depreciation. If somebody here had a manufacturing business, or maybe they had a commercial building, they had a bunch of big expensive equipment, I'd probably talk about this more. But I don't know that there's, you can see here some examples of vehicles that qualify, that meet that 6,000 pound mark. And you can, oops, sorry, I think I bumped that there. If you're looking to buy a new vehicle, say in 2022, and you're like, oh, I think I want to maybe wait and buy it later in the year to try to manage the mileage so I can get as much benefit as possible. And I was already thinking about an SUV. Just go Google. is my vehicle is this vehicle 6,000 pounds gross vehicle weight or not? Because then it qualifies for this 100% bonus depreciation. So that can be a pretty powerful tax planning tool. The one thing I want to point out is that 100% vehicle depreciation or bonus depreciation I mentioned, that starts to phase out in 2024. So if somebody's like, oh, you know what, I just got a new car in 2020 and I try to keep my cars for 5 years, so I'll get a new one in 2025. Well, as we know, tax rules or laws can change every year anyway. But I just want you to be aware, if you think you're going to wait till 2024, talk to your tax pro before waiting too long. And I want to inject a comment here, because oftentimes we get caught up in tax planning and spending money on stuff because there's a tax benefit. Something has to make business sense first. And I like to tell clients, we don't want to let the tax tail wag the economic dog. So spending money just for a tax benefit, even if you're in the top tax bracket of say 40%, well, you still spent 60% of your money on something maybe you didn't need just for a tax deduction. So I just want to keep that in mind as we're talking about tax stuff, particularly tax deductions and tax planning. The next topic I want to hit on is health insurance. So depending on how you get or how you pay for health insurance, when I started my practice, my wife had a more traditional corporate job. And so we got our health insurance through my wife's employer. So the first couple years that I had my practice, I didn't have a separate health insurance deduction for business tax purposes. But if you pay for health insurance out of pocket, then that's something that is typically going to be tax deductible. If you have a side gig and you have health insurance, let's say you've got a day job and you have health insurance through your employer, or Jake, I'm just taking a guess here, if you were part of a union because I think you worked for the school district, it sounds like, if health insurance is part of your retirement plan and you don't have to pay anything extra out of pocket for it, then this would not apply to you. But if you're paying, if anyone's paying for health insurance out of pocket, this is something you want to make sure you are getting deducted on your business tax return, however it's being filed. If your business is set up, if you're doing business as an LLC, but for tax purposes, you're still filing on Schedule C of your personal returns, so you're being taxed as a sole proprietor, you can be paying for the health insurance in your personal name. That's fine. But if you're doing business as an S Corp, the S Corp needs to be making your health insurance premiums. Is this anything, I just don't want to belabor the point if it's not applicable to anyone. Is this something that applies to anybody here, health insurance that they're paying for? No, I'm seeing.
Well,
Betsy?
I have one employee who is my son, and he's, it pays almost nothing on Minnesota Care, but I / the gallery pay that. It's kind of nominal, so it doesn't really matter, but it could be different. I guess, if he wanted to increase his, if he or I wanted to increase his rate, so he made like big money, then they're in health insurance. This is paying. The question is not my personal health insurance, it's an employee health insurance.
Sure.
So which you may not want to, that might not be relevant to anybody else.
Well, it's something that, so if your son is an employee of the gallery, he's getting paid as a W-2 employee, I presume.
Yes.
And is the gallery paying for his health insurance, or is it being deducted out of his check and he's paying for it, basically?
The gallery's paying it.
The gallery is paying for it. Okay. So that sounds like that certainly should be a tax deduction for the gallery, because the gallery is, it's a bona fide legitimate business expense. It sounds to me like, it's probably already being picked up through your payroll accounting, I would presume. So,
Well, I mean, I know how it works, but I actually pay it, but rather than the payroll, but I mean, it could be done that way.
yeah,
But it isn't, but it could be. But I understand how it could be. Yeah.
yeah, but it for sure, regardless of, well, structure could matter. And I don't want to get too personal, because I know that, it's not a one-on-one conversation. But depending on how you're structured, I would just maybe double check with your tax pro that one way or another that's being deducted, because it certainly sounds like a business expense, whether it's being done through the payroll system or whether the gallery is just writing a separate check once a month or once a year, however the premiums are being paid, however frequently. It sounds like a business expense to me. So,
Okay.
Anything
Thank you.
else?
yeah, Jake.
Yeah, I'm retired, and I pay like about $250 a month for health insurance.
Okay.
Would that be through you, Care? So is that deductible?
Yeah, I mean, that certainly sounds like that should be deductible. You don't have, I mean, yeah, that should be deductible. As long as you are,
Because it's coming directly out of my Social Security.
okay, yeah, that should be deductible. So let's talk about the home office deduction. And the mechanics of how this gets reported differ a little bit from the sole proprietor structure for doing business versus the S corp structure of doing business. But the numbers are more or less the same. So the way that the math works is we look at what's the total square footage that you heat and cool of your home. So if you've got a 2-story, or if you've got a walkout Rambler, but your basement is unfinished and you don't heat and cool it, even if that home is 2,000 square feet, but you're only heating and cooling the 1,000 square feet on the main level, that's the number we'd use for your home square footage. And then we would look at how many square feet is your home office. Now, your home office, just to be clear, doesn't have to be a separate room. It can be, it can be a corner of your dining room. It can be, if you do have a finished basement or a finished attic, it could be, a corner of a larger finished room. But it does need to be a space that is being used primarily as your home office. So an example would be if you've got a bedroom that you actually rent out Airbnb, but when it's not being rented out Airbnb, you use it as a home office. And let's say you Airbnb it, at least 7 days a week. I'm sorry, not 7 days a week, 7 days a month. So some regularity. It might be hard to claim that bedroom as also being a home office space. But if you can point to the corner of a larger room and say this 10-foot by 10-foot square here is effectively my home office. Okay, so now we know you've got a 100 square foot home office. So you've got what might be a guest bedroom, but you never have guests. It's really used as a home office. And it's 12 by 13 feet, whatever that comes out to. So then we just figure out what the percentage is. So if we've, just for easy math for me, if we've got a 100 square foot home office and 1,000 square foot home, so now we know 10% of your home expenses we can allocate towards your home office. So, expenses we're going to look at are going to be utilities, your homeowner's insurance, your property taxes. If you've got a mortgage on your home, we can use the mortgage interest that you pay. We add all these up. Frankly, if you've got a snow removal service, nobody in Grand Marais has one of those. If you've got a snow removal service that you pay, we can use that. If you have lawn maintenance, we can use that. Although I don't know, my place in Grand Marais, about the only thing we grow are rocks and aspen, but that's another story. Any expenses like that, propane, obviously I know for a lot of folks that's a big way of heating, and I would even say wood. If you actually can say that one of the ways that you heat your home is through wood, and I don't know if you're paying $500 to $1,000 a year for wood. That's something that we can factor in. So
We have a question. We have a question from someone regarding some of those things.
Yeah, sure. Shoot.
They wrote, my home office is in a separate room, also used as an entertainment room in the evenings. Can I use the whole square footage of the room for the deduction, or do I just use the space used by the desk and printer?
I would say we would just want to use the space by the desk and the printer. And so if like the larger room, and actually I have the same, where I'm sitting right now is a much larger space, but I count basically 10 feet by 10 feet as my home office. But the room itself, we have a TV and we've got a bunch of, well, I almost said a naughty word, but I know I'm being recorded. So we have a bunch of stuff that we need to go through. Yeah, so that totally works. That totally works. If you could like put an imaginary line or put, tape on the walls or tape on the floor and go and do an outline and say, this is my home office space. You don't have to have walls. And if it's part of a larger room, but if you can like legitimately say, yeah, I've got a desk set up here and a printer stand, and this is where I do my, my administrative work, for sure. For sure. Anyway, so for the home office deduction, so if you do business for tax purposes, you're filing your business activity on Schedule C of your personal return, then the home office deduction actually is made on IRS form 8829, which just then becomes part of your personal tax return. And on that form, it'll talk about mortgage interest, and it'll talk about insurance, and it'll talk about utilities, and it'll talk about property taxes, all most of the things I mentioned. And then it's got other, which is, where you'd put wood for, for burning, or what else might you put there? Snowplow removal. If Betsy lived up in Hoveland and, she's not getting to the gallery if the snowplow guy doesn't show up. I shouldn't say guy. It could be a not a guy, too. So trying to not be using gender stereotypes, but Terry, you have a question? I
do. Is there a limit on the space that you can have in your house? Because I've almost taken over our whole house.
No, that's a great question. I've never seen a limit, and I've got clients where they have a product, and I can totally see this with a lot of folks that are artists, working artists, where you've got, maybe you have a separate gallery space outside your home, but you store your wares, in the attic or in the basement or the garage. Now, the trick would be like if you've got stuff stored in your garage, and if your garage is not part of that, heated and cooled space, as part of the home square footage, the total home square footage, then I don't think we could count something like that. Or if you've got something stored in an outbuilding that's not heated or cooled, that's actually, it's something I've never really thought about, but I don't think we could count that. But I mean, if it's like truly in your house and it's in the basement and you've got, a spare couple rooms or just a bunch of space in the basement that is used to store, whatever, for sure you can use that. You can include that.
Perfect, thank you.
Absolutely. Absolutely. Did I answer your question for you?
You did, absolutely perfect, thank you.
Okay, good. I want to make sure. I don't know if this is a free class or if you paid $1 million. I just want to make sure everyone's getting their money's worth. So if it's free, you get what you pay for. I can probably stop now, right? All right. So if you're doing business, I'm just to continue on this home office deduction. I'm sorry, Adria, I probably shouldn't be making cracks like that.
No, it's quite all right.
Okay, good. Like, yeah, he won't be teaching for us anymore. So one thing I want to mention with the home office deduction, if you do business as an S corporation, so something I haven't touched on is businesses, most small businesses in my experience are what we call cash. They use the cash accounting method. So what I mean by that is you don't recognize sales or income until you've actually received payment. So for example, particularly for the artists, if you folks have stuff on consignment for sale, even if something sells around Christmas time, in a gift shop, and maybe the gift shop owner says, hey, can you replenish? But I don't know what your arrangement with the gift shop owners, if the gift shop owner cuts you a check for that sale, but maybe they don't want to cut a check every time an item sells. Maybe it's just once a month or once a quarter. I'm not sure what your arrangements might be. But if you don't get that check until January from your consignment sales, that's not December income. Even though the product sold in December, you didn't get the cash until January. So if you're using the cash basis or the cash method of accounting, which I think most of you are or probably should be, we're not going to recognize that December sale until you actually get the money in January. So we don't have to count that as part of your income for the prior year. We'd count it for the current year because you didn't get the money until January. My point being, if you have an S corporation, the way that we want to do the home office deduction is we're going to treat it as an expense reimbursement. So there isn't a particular form that we're going to fill out like we would if we're doing business as a sole proprietor and we're reporting on Schedule C of your personal return. We're going to do the calculation probably in late December, and then we're going to have the company cut a check to you personally, and we're going to call it expense reimbursement for home office. And the beautiful thing about that is it is an expense for your S Corp, and it's not income to you personally. But you have to cut that check in December, in late December, because the business is a cash basis taxpayer. So if the business cuts that expense reimbursement check to you in January of 2022 for your home office deduction expenses for 2021, the business won't get to use that deduction, that expense reimbursement, until the 2022 tax return. Clear as mud? Okay. So I'm done talking about home office. Before I go on to retirement plans, do we have any other home office questions? Okay, the silence is deafening. So retirement plans. Everyone's probably familiar with the kind of the standard, there's the traditional IRA and there's the Roth IRA. And if you are under age 50, you can put up to $6,000 into a Roth or a traditional IRA. And if you are 50 or older, at the end of, in this case, we'll say 2021, then you can put $7,000 into a traditional IRA or a Roth IRA. Now, the advantage of a traditional IRA is when you put that money in, unless your income is, I'm going to say, over a couple $100,000 a year, when you put that money into a traditional IRA, it's going to be tax deductible. When you pull the money out of the traditional IRA at some point down the road, that will be considered taxable income to you. With a Roth IRA, when you put that money in, it is not a tax deduction going in. However, when you pull the money out, typically starting at age 59 and a half or later, it is not taxable income to you coming out. And so the beautiful thing about a Roth IRA is if you put money into it, say $5,000 a year for 10 years, so ignoring compounding and market return, let's just say you've got 50 grand sitting there. When you pull that money out, it's not going to be taxable income. But if you've invested it, hopefully it's grown and grown substantially. So your $50,000 could be $250,000 and it won't be taxable income coming out. There's something called a SEP IRA. Now, the SEP IRA is available to people who are filing on Schedule C of their personal return, so they're sole proprietors. Or you could have a partnership, be a partner in a partnership, or you could have an S corp. A SEP IRA, you can put up to 20% of what is considered earned income. And I'm going to talk about what this earned income term is. Earned income is where you receive income that you've earned through your service. So W-2 income, for example, if you're an employee somewhere, that's considered earned income. Okay, you got paid because you did something for someone. If you have a business and you have income and you're doing business as a sole proprietor, and we said earlier that that income is subject to self-employment tax, that would be earned income. If you have a partnership and you work actively in the partnership, I use the example of me and if I had a business partner, and we had profit at the end of the year of $100,000 and we split that, my $50,000 would be subject to not only income tax, but that self-employment tax, which is Medicare and Social Security. That would be earned income. And in that example, if I had $50,000 of earned income from my accounting business, I could put up to 20% of that into a SEP IRA. So 20% of $50,000 is $10,000. And that's nice. Depending on what your income level is, there's something, I think all of us are familiar with 401ks, particularly if you worked at a larger employer at some point in your career, you probably were even able to participate in a 401k. For people with small businesses, if you've got a fairly profitable small business, well, actually, you don't even have to have that much of a profit. There's something out there called a solo 401k, which is super powerful from a tax planning and a retirement planning perspective. So everyone's probably aware that when you've got a 401k, as an employee, you can contribute to it. And then hopefully you've got an employer that will contribute. Usually it's a smaller amount. They do a batch, right? So if you've got a business, you can set up a solo 401k and you can defer, if you are under age 50, up to 19,000. I'm sorry, it just changed. Well, for 2021, it was $19,500 that you could defer. So you could have a W-2 from your business let's say, of $50,000, and you could elect of that to have 19,500 of that $50,000 salary deferred into your W-2. And then your company, you own the company, can actually put up to 25% of your W-2. So 25% would be 12,500 into your 401k. So if you had from your company, if you had a $50,000 W-2 salary, you could defer 19,500, and then your company could match 12,500. So I want to say that gets us to 32,000, somewhere in there. So that's a pretty nice amount going into retirement plan. And the amount that you defer, that 19,500, is not going to be taxable income to you as an employee on your W-2, because your W-2 will get reduced by that amount. And when the company does that 25% match, in this case, I use $12,500, that match is going to be deductible for the business. So it's going to help reduce the profit in the business. But really all you've done is taken money out of your left pocket and put it in your right pocket. But it's a tax deduction, and it's going to save you on taxes. The beautiful thing is, in my case, for example, I'm almost 52. I don't know how that happened, but it did. And I can defer, because when you hit age 50, you can defer not 19,500. You can defer, let's see, it's an extra, I want to say 6,500. So you can defer $26,000 of my $50,000 W-2. So, so the amount that I can put using that math, I can put $26,000 into my 401k as my employee deferral, and then my company can match 25% of that $50,000 W-2 for another 12,000. So 26,000 plus 12,500, I can get 38,500 into my 401k for 2021 with a salary of $50,000. So you don't have to be making $1 million here to do something like that. Anyone have any questions on that stuff? I know it's kind of a lot of like mental math.
Yeah,
I'm gonna go.
I have a question. So just to, were you
Hold on a
saying,
second. I'm sorry, I didn't even know that you were on the call.
yeah, I typed in a question before. I don't know how to raise my hand. Is there a way to like raise your hand?
We must have just enough people where not everyone is showing up on my, that it's probably
Yeah.
user error. Okay, I fixed it now. Sorry.
That's fine. What's the question? You just say that when you were talking about the deferring to the W-2, no, that's assuming that you're an S corp and you actually have a W-2 and like a salary for yourself.
That's right.
Or,
Although you could,
okay.
the math would work a little bit different. You could be a sole proprietor and have could you do that if you're a sole proprietor? Yeah, I think you could be a sole proprietor and have a solo 401k. The math works a little bit better if you're an S corp. And frankly, if you're dealing with numbers like that as a sole proprietor, I'd probably almost suggest being an S corp anyway. And that's a separate conversation we can have offline where we're it's not an example in class.
Okay, it just was clarifying that. Okay, sure. Thank you.
Yeah, you bet. And I'm sorry, how do you pronounce your first name?
Ilunia.
Ilunia, okay, got it. Terry, question?
Yes, I was wondering for the S corp, what would be the a good amount that you would have to make to file that way? I mean, as an artist, we don't make an astronomical amount of money, but I was just wondering what would be a good amount to make for the S corp if you went that way.
Yeah, I would say it probably makes sense to start having conversations with your tax pro when your profit in the business probably in the $40,000 to $50,000 range. S corps are, from an administrative standpoint, they're a little more expensive. Because now you're not filing just the business activity in your personal return. Now you're filing a separate business return. And an S corp typically requires you to have payroll service. Now, if you don't have employees, you can just run payroll once a quarter. It's not like you have to run payroll every week or every 2 weeks or twice a month. But there are some additional pay in the rear end factor. So
How would the IRS like it if you used as a partner your husband?
I think that works. Yeah. But I don't know. I mean, at that point, I would say it would be, if it's sole proprietor, I wouldn't even be a partnership. I think I just go right to S corp.
Okay.
Yeah.
Thank
Because
you.
the tax savings that can be had by saving on that self-employment tax, the payroll tax I was talking about, you don't get a benefit there at the partnership tax scenario.
Okay.
It's basically, it's either Schedule C sole proprietor or it's S corp.
Okay.
And like I said, it's usually around profit of 40 to 50,000. And gosh, I hope, I mean, I know it's tough, it's not like there's one ceramicist or one jeweler in town, or, but it's, God love y'all. It's because that's one of the reasons Grandma Ray is Grandma Ray, is because of the,
Yep.
I'll stop my editorializing.
We have one more question in the chat, Nils.
Sure.
Agni says, can you please touch at some point if there are any specific deductions for real estate commissions received?
Okay. Golly gee, I thought I fixed like my view so that everyone would show up, and I'm sorry, Agni isn't showing up. So
yeah, it's hard to see everyone. So we have 1, 2, 3, 4, 5 other people besides me that are attending. So
I'm gonna beg your pardon. I'm just gonna crack a can of caffeine here. I've been going since about 5 o'clock this morning. So okay, so can I please touch on some point if there's any specific deductions to real estate commissions received? Okay, so I'm going to take a wild guess that Agni, and I apologize if I'm not pronouncing your name correctly. I'm going to take a wild guess that you are in real estate sales, you're a realtor, whether it's full-time, part-time. I actually work with a ton of realtors. I probably have like 25 realtor clients, and half of them are invested in real estate. But so there are going to be a ton of expenses. They're going to be, for real estate commissions. So you get a real estate commission, whether it's a property you sold that you listed, or a property that you were representing the buyer. You're going to have mileage. You're going to have, I mean, I know like down in the Twin Cities here, there's the Minnesota Minnesota Realtors Association. We've got, I imagine there must be something like an Arrowhead Realtors Association or something along those lines. So any professional dues, membership, you've got your license for sure. We talked about mileage. You're going to qualify for a home office deduction. Trying to think if there's anything specific. I don't know if you guys have MLS fees up there. I know down in the metro area, MLS fees are like a recurring monthly thing. You've got the Supra key for the electronic keys, lock boxes that people use down here. Again, I don't know if that's the same for up there. Of course, if you're selling land, there's nothing to lock up. It's just, we'll drive out and look for a fire number, but so those are just some that I've just coming up with off the top of my head. So hopefully that touches on some things. I mean, if you don't get health insurance through some other means, health insurance would certainly be a deduction for you. So I'm going to move on and continue with my riveting slideshow. Okay, thank you. Thanks for the feedback, Agnes. Since I can't see you, and I'm sorry about that. Technical error on my end, I'm sure. So I'm going to keep going with slides. And does anyone here have a health savings account or familiar with health savings accounts? Okay, I'm seeing some yeses and some nos. So, so we'll spend just a few minutes talking about health savings accounts. HSAs. Thanks for the feedback there, Elunia. So, HSAs are basically like a bank account, and if you are paying for your health insurance, and I presume you have a high deductible, and a high deductible, the IRS defines a high deductible health insurance plan. As it says right here, if you are an individual and have an individual health insurance plan, if your annual deductible is $1,400 or more, if you have a family health insurance plan, if your family deductible for the year is $2,800 or more. HSAs are awesome things if you qualify to have one. And I have seen some folks who have, maybe they get their insurance through, MinCare, MinSure, something like that. You might want to double check to see if your health insurance plan is eligible for you to have an HSA, because in order to have an HSA, you need to have a qualifying health insurance plan. But an HSA is super powerful because when you put money into the HSA, and the HSA is basically just a bank account, but the money in the HSA is money only to be used for healthcare expenses. You cannot use that money to pay for your health insurance premiums, but you can use that money to pay for stuff that your health insurance doesn't pay for. So office visit co-pays, crutches, if you, heaven forbid, had to, were in a bad accident or something and, couldn't get around for a while and they had to get one of those electric scooters, you could use it for that. Prescriptions, eyeglasses, optometry appointments, dental, anything not covered by your health insurance plan, you can pay for using your health savings account. But you have to have money in the HSA to pay for it. So when you put money in the HSA, if you are a single person, you can put 30, and I'm going to say these numbers are the 2021 tax year numbers. They go up just a little bit every year. So as a single person, you can put $3,600 into your HSA, and you can actually still do that up until April 15th of this year and get the deduction for last year, for 2021, have it count on your 2021 tax return. And then the dollar amount's the same, or it just doubles for family. And, family, you don't have to have a spouse. You could just have a child, a dependent child. I mean, you could probably even maybe do that because, you can have kids up to age 26 on your health insurance plan. But this is a super powerful tool. And HSAs, I know a lot of people, in the corporate world, there were those old flex spending accounts where it was use it or lose it, where you put money in, to pay for certain healthcare expenses. And then at the end of the year, you're scrambling, trying to make doctor's appointments and dental appointments because I got $2,000 sitting in this account. If I don't spend it by the end of the year, maybe a short grace period of a month into the following year or something, the money was just, sorry, you don't get it. HSAs, this money is yours and it never goes away unless you spend it. So the balance can carry over from one year to the next. So it's a super, super cool tool. And I encourage all my small business, well, all my clients, whether they have a small business or not, to, if they qualify, to seriously consider having an HSA and contributing to it. Because HSAs, once you've got, I think it's about $2,000 in there, you can actually invest that money. And this can become an additional source of funds for retirement. You can contribute to an HSA up to age 65. And in some cases, you can contribute past that. But this is good financial planners will take this into account when working with their clients. Anyway, but HSAs, super powerful. And if you've got one and if you have the financial wherewithal, I'd contribute to it. And when you put the money in, it's kind of like the traditional IRA. When you put the money in, actually, it's better than the traditional IRA. You put the money in, it's a tax deduction. And as long as you're spending the money on qualified medical expenses, which I just kind of rambled through a minute ago, the money coming out is not taxable. So it's pretty cool. Any questions on HSAs? Everyone's still awake? That's a good sign. All right. Let's see here. Hire your kids. This can be a way, and it depends on how you go about it, depends on how your business is structured. So if you are a sole proprietor, you can actually hire, kids under the age of 18, and the money that you pay them is a tax deduction for your business, and you do not have to withhold Social Security and Medicare. And up to a certain point, that point being $12,550, your kids wouldn't have to claim it as taxable income, but it's a business expense for your business. It can be a nice way, and this does have to be legit. It can't be like, oh, I'm just giving my kid an allowance. It happens to be $1,000 a month. You have to, I would recommend paying your kids, some reasonable hourly rate. Probably can't pay them $50 an hour. Maybe $20 an hour would fly, depending what you're having them do. They can do stuff in the office. If you're an artist, you could hire your kids. Maybe they could help clean up after a project, or they could help with setting up. I'm just, kind of, maybe my examples aren't great, but I'm trying. If you had gallery space, they could help clean the space. And this is really legit on down to, I'd say about 7 or 8 years old. I mean, we have tax court cases where the tax court said, yeah, this was legit. They were paying their 7 or 8-year-old to help clean. And they've got, documents, records to show that. So, kind of a cool thing. And I wish my parents would have done this. Heck, I wish I would have thought about this when my kids were younger. You can, I mentioned earlier the traditional and the Roth IRAs, that in order to contribute to them, you have to have earned income, so income that is subject to Social Security and Medicare tax. You could have a kid, say 9 years old, and pay them $6,000 a year. And they're doing legitimate work. So it's $500 a month. They could take you as their parent, you could direct the money that you pay them. It has to go into their personal account, but then you could have that money go into a Roth IRA. And could you imagine the power of being 9 years old and even just once having $6,000 go into a Roth IRA, into some mutual funds, tied to the stock market, and then let that money ride for 50 years. I mean, what that $6,000 would look like. I mean, you might be long gone, but your kid, when they get access to that money, they're going to be thanking mom and dad. Hopefully not writing a book like Mommy Dearest. I probably just dated myself because nobody knows the book Mommy Dearest. I think that was Joan Collins' daughter or something. But okay, maybe a couple of people know. So there's some pretty cool things you can do with hiring your kids in terms of transferring income if you're at a higher tax bracket to lower or even a no tax bracket. But yeah, it can be a tax deduction for your business, again, legitimately. So
but this is not adult children that you're talking about, right? This is kids.
That kids, or kids maybe. I mean, if you've got an adult, I'm trying to think. Well, you know, I mean, Betsy, if you're, I'm just making up numbers here, but let's say, let's say you're in the 30% combined federal and state income tax bracket. And let's say your son is in the 15% combined Fed state tax bracket. If you want to get more money to your son, I mean, presuming he's handling it responsibly, I'm not trying to say anything, but just, if you want to look at it kind of as I'm going to get some money that might be my, estate to my kid now, you could look at it if you think he's going to be responsible with it as, basically I can get money to my son at a lower tax bracket than if I just pay my income tax rate of 30% and then just gift it to him. And there are probably no tax notifications of the gift, but you've paid 30% on that money, as opposed to maybe paying your son more, and he's in the 15% tax bracket. So now kind of in your global tax picture, if you will, as a family unit, you're saving a little on, saving 15% on that tax. Does that make sense?
Yes, yep,
Okay.
good, that's good. I wouldn't have thought of it.
Sure. Anyone else questions on hiring kids? I don't want to beat this if it's, not even a thing. So, all right, I'm going to move on and see. Okay, so, and I was terrified, and I could have really gotten into the weeds, and I honestly, my wife saw the slides that I had prepared, and she's like, "Oh, you're gonna bludgeon people to death with words," because I had 20 slides and they were just full of just stuff. So I'll thank her later. But I wanted to say that I think because she pared it down, it prevented me from going down some rabbit holes, which was probably a good thing. But we're going to have time for more questions because we were scheduled 6 to 8, and I want to make sure everyone's getting their money's worth. So, a few thoughts. One is, and I kind of touched on this earlier, from a tax planning perspective, again, your businesses are all what I would imagine are going to be cash basis. So if you have clients that you get paid from on a regular basis, let's say you're selling art on consignment, and I don't know what your arrangements might be, but maybe you get a check once a month instead of getting a check every time a piece sells. So maybe the consignment shop isn't excited about writing 50 checks a year or something like that. But maybe depending on what your relationship is with the various consignment shops that or gift shops you're working with, maybe it makes sense to tell them, what, don't, any sales that you make in November and December, don't send me that check until January. And then what you're doing is you're taking that income that presumably would be profit or taxable income, and you're pushing that out a year. And so instead of that being taxable income, say in November and December of 2021, now that's going to be taxable income in January of 2022. The same idea holds for expenses. So if you've had a good year and you're in a good cash position, again, I'm not saying go buy stuff you don't need, but if you thought, gosh, I was planning on buying a vehicle in the next, 6 to 12 months anyway, maybe it makes sense to buy one now in November or December, really manage how much I drive it for non-business use, and I'll get a bigger tax deduction on my tax return. The same, I see that all the time. Clients will buy computers in December. And again, maybe they're going to buy computers in, the first half of the following year anyway. So, or they notice they're low on office supplies, or they're low on, art supplies. Maybe it makes sense to stock up on some of those things at the tail end of the year. And you don't have to pay cash. You can pay with a credit card, and you don't have some, I know sometimes people say, well, if I pay with a credit card, if I buy something in December, do I have to pay that credit card off before the end of the year? The answer is no. So I know sometimes, Best Buy, for example, they might have financing deals where they'll say, we'll finance you, meaning basically you get a Best Buy credit card on your computer purchase, we'll finance it for 6 months, no interest. You don't have to pay the Best Buy credit card off before the end of the year. You can let that ride. You've made the purchase. So those are things where we can kind of manage, defer that money coming in and accelerate that money going out, so that at the end of the year we kind of look poor. I've always said, this is kind of a weird business because my clients want to be rich 364 days out of the year. And then that one day of the year when they actually file their tax return, they want to look poor. So it's can be kind of an odd deal, but so that's another strategy, if you will, so to help manage income. Gosh, I feel like I've shortchanged everybody. I think I'm at the end of my slides here. I don't know. I don't know any good jokes. So.
Well, do we want to just open it up for questions? If anybody has any specific questions that they have just burning on their mind.
Works for me. Terry seems pretty eager.
Oh, Betsy, you
I have a
had
couple
something?
of questions.
I'm sorry.
No, go Terry.
Okay.
Go ahead, Terry.
So if I'm buying equipment during the year, say it's a big buck item, am I able to put all of that on my taxes? And do I get all of that off of my taxes?
So if it's equipment for the business that's used 100% for the business, the
Yep.
answer is yes. So so if you buy a $5,000 piece of equipment in July, but it's used 100% for business, then you should have a $5,000 deduction for that tax year that you bought it in. Yeah.
Okay.
Or
and
if you
another
want,
question. Do
go
you
ahead. I'm sorry.
recommend having separate accounts? Do you recommend having separate accounts for your business and your personal?
Can I get an amen? Yes. So, and this is not uncommon. For a lot of people, a hobby or a passion turns into a business, and there's an evolution, right? Honestly, I was doing, I'll just use myself. I had a W-2 job where I did accounting and tax work. And then I had, the old family and friends, and then neighbors, and then their family and friends starting coming to me asking if I can help them with taxes. And all of a sudden I've got a business. So, and I can imagine it's the same, for some of you. So, all of a sudden now, yes, you absolutely need to have a separate business account. Even if you're doing business as a sole proprietor, run everything through your business bank account. It's going to be much easier to track. And I can tell you, if you have created or thought of creating an LLC just for legal liability purposes, one of the ways that in a lawsuit your LLC can be negated is if you create this LLC. Even if you create a separate bank account in the name of the LLC, and you even get a separate tax ID number for the LLC, but if you are running a lot of business transactions through your personal account, or if you're running personal transactions through the maybe I just misspoke. If you're running business stuff through your personal account or personal stuff through your business account, the courts had actually said, well, you're not respecting the LLC as a separate legal entity, so somebody can sue you personally. Now I know that you're not like building explosives, or you don't have rental real estate probably. So maybe you're not so concerned about that. But yeah, you absolutely want to have separate accounts. And I can tell everybody that the better your record keeping is, particularly when you come into the fourth quarter of the year, the better chance that Tax Pro will have at helping you save and or plan for taxes, or save. Tax planning with bad numbers is, you've heard the expression, probably garbage in, garbage out. I mean, if you don't have good numbers to use for tax planning, it's going to be hard to really save you some money, because if we don't know what we're dealing with. So did I beat that horse dead there, Terry?
You did, you got it good. One other
Okay.
question for if you bought a car, it doesn't have to be a new car, it just has to be new to you.
That is absolutely correct. It does
And
not have to.
And you don't have to worry about how many miles you put on it. You can still use it for personal use, but you basically have to keep really good records when you use it for business use.
If you have a vehicle, regardless of which one of those methods we were going to use, you still need to be able to prove, in the event of an IRS audit, you need to be able to prove the driving that you did do for business, even if you only drove the vehicle 20% of the time for business.
Okay.
And again, that's not something that a tax professional, well, I suppose they could say, show me your logbook. But tax professionals don't work for the IRS or the state of Minnesota. They work for their clients. Now, having said that, they need to let their clients know what the rules are. But yeah, it's a good idea. It's a really good idea to track your business driving, even if it's infrequent compared to personal.
Okay, thank you so much.
Yeah, you bet. Go ahead, Betsy.
This isn't necessarily small business tax, but would you say a little something about gifting money to family members in terms of the taxability of it?
Sure. So I'm going to throw a caveat out there. My caveat is it's similar to the legal one, but I've not done a lot of work in estates, gifts, and trusts. And so I don't want to hold myself out as a professional, as an expert. I know enough to be dangerous. So I can tell you that when you are gifting money to, you can actually gift anyone you want. It doesn't have to be family members. But I think the number we're at right now is you can gift up to $15,000 a year to anybody, and it is a non-taxable event. So there's no tax to you, the giver. There's no tax to whomever the receiver is. And it doesn't matter if they're a family member or somebody you just bumped into on the street. You've never met him before. Gifting, there's an interplay there between gifting and estates. And at the federal level, the number went up dramatically. I think if your estate, I want to say, is under $10 million when you die, I don't think then the gifting is even an issue. How much gifting you did during your lifetime. At the state level, because of course the IRS and the state of Minnesota Department of Revenue couldn't be the same, right? So at the state level, if your estate is $3.5 million, if it's under $3.5 million, I don't think we have state estate tax issues, if that makes sense. So I can see how, particularly when you have a lot of land, and if it's been in the family for, even generations, it could be worth quite a bit, and then you could have some issues. And the thing I do want to point out is if you're looking to get money to the, another generation, you can gift, like you could gift to your son. I'm just gonna, go with that. You gift to your son. If your son has a spouse or a significant other, you could gift to their significant other. If your son has kids, you can gift to your kids. And so it's 15,000 per person. So theoretically, like if my mom wanted to make a gift to me, and she could do 15 grand to me, 15 grand to my wife, and 15 grand to each of our kids. So she could actually get $60,000 to my family. But my wife would do something with it. I don't know what she'd probably buy more land. But anyway, so I don't know. Is that probably more than you wanted to know? But does that make sense?
Yes, and so there's not a way that the gifted money can be any kind of business expense.
That is correct.
Because if it were, for instance, if it were my, end of my annual bonus, to
Sure.
my prize employee, to me, it would be, or would be advantageous to the business to have that be an expense, but to him, it would not be advantageous to have it be an expense, to have it be income, but it would be income, correct?
Yeah, yeah,
Different from a gift.
yeah. If the money came from the business, as a year-end bonus, it would be deductible for the business, but then yes, it would be taxable to the prized employee. If you just gift money to that same person, it's effectively a non-taxable event, but it's not, there's no tax benefit for the business. So,
Right, yep.
yeah, I could think of ways. I could
Keep going.
yeah, I could think of ways to structure. Do you have grandkids?
Oh, I do.
Okay. I can think of ways to structure something that might, but where there could be the tax benefits to the business, and would not result in taxable income to, if you had minor grandchildren. I'd have to look at that a little more closely. And it might, yeah, I think there might be something there, but the, it might entail putting grandkids on the payroll. But and it depends. I know that might be an additional layer of complexity, but if you're already running payroll, maybe it's not that big of a deal. But if you don't actually run payroll, then you have to get a payroll system or service set up. But I mean, yeah, that I think there might be something there. I just have to noodle it a little bit more.
Okay.
So
all right, that's
so
good.
that's kind of a maybe, I guess.
All right, thank you.
Yeah, you bet. Anyone else have questions?
Yeah, I have a couple. This is kind of going off of what Betsy was saying, and it's kind of a clarification. I was gifted a sum when starting my business from my mom, and I do services only. No, there were no services rendered. It was just a gift for like startup costs.
Sure.
For me, is that from what you're saying, that's not taxable income.
Yes. So
because it wasn't something that was paid for, yeah. Is that correct?
That's right. And family can be tricky. And I mean, if your mom literally just gave you some money as a gift, the intent was, here, this is to help get, ABC company up off the ground, then that would be a non-taxable event. Again, presuming that the dollar amount was, under that 15,000
Yeah.
threshold I mentioned.
Yeah, for
Okay.
sure.
And then,
And that's
if-
irregardless of if it was written to me personally or if it was written to the LLC. They do have an
no,
LLC.
that's another wrinkle. So,
Okay,
if the check was written to the LLC, and this is where it's almost like a legal question, right? And so, part of me would say I would treat it as if it was written to you. If the
okay,
intent wasn't, if the intent was not for your mom to have some ownership interest or to be making a loan to the business, if the intent was seed money, she was just doing you a solid because she's your mom and she loves you, right?
right.
I think that the way it actually happened probably would be fine.
Okay.
But
Yeah, I kind of had that question
probably when it happened.
answered previously. I just wanted to,
Okay.
since I,
Yeah,
and it wasn't by a CPA, but by the woman who helped me start up the business in the first place, Pat Campanero. So,
oh, sure.
yeah. So then if you could just speak a little bit more about like the car, couple things, car expenses, and then like the vehicle deductions. So like for my business, I travel to and from people's homes to provide the service. I've been logging those miles.
Great.
I have not kept track of then how much I've used personally since starting the business. I know for a fact that I've driven less for the business than for personal use, at least over the course of 2021. So does that mean that in years forward, that I can only do that standard method moving forward?
That's correct. That's
Okay.
right.
Okay.
So, yeah, so you'll use the standard mileage method for every year going forward, as long as you have that particular vehicle.
Mhm.
And if you ever replace it, or if you keep it and just continue to use it as a personal vehicle, but you get a new vehicle that you're going to use as your business vehicle, then you get to take the hourglass and flip it over and it starts over.
Okay.
So if in the first year with the new vehicle, if you qualify and in fact do use the actual expenses method, so more than half your driving was for business, then each year after that first year that you got that new vehicle, you could flip-flop between the two methods, whichever gave you the better tax deduction.
Right. Okay.
So.
And then, so along those lines, when you were mentioning like traveling to and from Duluth and stuff, there was once that I traveled to Duluth for personal reasons, but I also stopped at an Office Depot to pick up some things.
What was
And
the
I was looking at desks, but I didn't buy a desk there then. I
Sure.
later bought one online because they didn't have, what I was looking for. Would that count as like, just for added miles, the trip to and from Duluth?
Yeah, so that's a good question. So I think if it
didn't
were,
buy much, but
yeah, and
Yeah.
we're being recorded. I should remind. No, I'm just kidding. But I'm sorry. I didn't mean to like jack anyone's blood pressure. I'm teasing. So what I would say is, if it was you, me, and an IRS auditor on this call, the IRS auditor, I think, would say that those miles to and from Duluth, because the reason you made the drive it was personal.
right.
It was just like incidental or just convenient for you that, I'll just swing by wherever and look at desks. And you wound up not getting. If you reverse that fact pattern and you drove there specifically to look at desks, and if in fact you went to, or you had planned to go maybe at 2 or 3 different places that sell desks to look at them, and while you were there, you're like, oh, you know what? I should see what John is doing, or Peggy is doing, or Mom is doing, or whatever, and see if they can grab a beer or grab a coffee or whatever the case may be. Because, you know, now the fact pattern is that what was the purpose of the trip? It was to
Okay.
look at desks. So the way you stated it the first time, the purpose was for fun and giggles, and but
Wouldn't say
you
it was
see-
fun, but
Yeah,
it's just not
okay.
business related.
sure. But you see
But
how
yeah.
just positioning it differently, you know, now that's an extra, what, 230 miles of round trip driving, you know, that we could take.
Okay.
So,
I think that answers, yeah, that pretty much, so then like car expenses, car payments, that type of thing, that only works if you're doing an actual.
The actual
okay,
method.
so this is moving forward. That's a good thing to keep in mind, including like the cost of the car, correct?
Absolutely.
Okay,
Yep.
all right.
So it's,
That's,
yeah, if you've got a, so like if you're leasing the vehicle, it's still all those expenses plus the lease payment. And then we're just multiplying it by whatever percentage we actually drive for business.
yeah, thanks a lot.
Yeah, you bet. Terry, go ahead.
Do you recommend doing an LLC for small business? Is there an amount of money that you have to make in order to do that?
Well, the LLC, just creating an LLC and running your business through the LLC, you know, there's nothing we're doing there that's has a tax implication just in and of itself.
It's just protecting you.
It's just legal protection. And so, you know, depending on what you, I mean, you know, I'm just thinking about, you know, if I were a home builder in the area, or if I was, who's the McKeever, whoever drills all the wells in Cook County. Yeah. You know, for sure. I mean, you know, they're driving a truck. I remember they said, yeah, one of our trucks with all the gear weighs as much as a fully loaded cement truck. I'm like, oh, I think I'd be an LLC and have good insurance. But, you know, I mean, if your business, or, I mean, you know, frankly, if you even have a physical location where somebody could, you know, where like it never snows or gets icy in Grand Marais, right? And
Yeah.
all the sidewalks are perfectly flat and level, not. So, you know, even if I had any kind of real estate in Grand Marais, I would want it owned by an LLC because I would want that legal protection. So whether it's customers coming in the door, or if it's a rental property, you know, tenants or guests of tenants, so no one's going to sue me. You know, if I'm selling pottery, I don't know, I can't imagine how that could be a liability, but I'm not a creative lawyer either. So,
Okay. How about if you use 2 cars for business? One car is strictly for business and the other car is the one you take to Duluth because it'll make it.
okay, sure. So, okay. So if you've got 2 cars, the one that is strictly business will be actual expenses. The one that is, you know, it sounds like less than 50% business, but is the one you drive to Duluth because you know it's going to get you back home at the end of the day.
That's correct.
Yeah, we would do the standard mileage rate for that one,
Okay, perfect. Thank you.
for sure. And I see we're coming up on 8 o'clock. I can be here all night.